This is 1b from the mock, using diagrams to discuss whether an increase in scale for firms in oligopolistic markets is more likely to increase or decrease their profitability. If you look at the mark scheme, I think the key phrase here is actually profitability. So if all you did is draw economies and diseconomies of scale diagrams, you're going to struggle to get you're going to struggle to get past about sort of 12, 13 out of 20, I would have thought. Because all you're really focusing on there is the cost aspect. If all you did really is to kind of say, well, if there are economies of scale, costs go down per unit, and so profit goes up, and you have diseconomies of scale, costs go up, so profit goes down, well, you're not really getting to the heart of it. It's obviously not that type of diagram that they're thinking about. So what we need to do is to kind of be able to fully demonstrate the effect of economies of scale on a theory of the firm diagram. So here's our key diagram. Sorry, I just forgot to get myself a different colour. So what we can see is, to start with, the firm will be producing at the profit maximising output, Q1. All the units up to that point add more to revenue than they do to cost. The price is going to be there at P1, and the cost per unit determined by the average cost is at C1. What we're now saying then is that as a result of economies of scale, it depends on whether they have economies and diseconomies of scale. Let's suppose that the firm increases its scale and it gets economies of scale. What that does is it's going to reduce average and marginal cost. So we're going to end up with an average cost curve, something like that, at AC2, and we're going to end up with a marginal cost curve still, that should be a 1, sorry, still passing through the minimum points of the average cost curve. The firm now has a larger output at Q2. And because marginal revenue is positive, the firm's going to have a higher total revenue than it did before. But what we can also see is that price has gone down a little bit because it's selling more units, but demand is price elastic because we're on the top part of the demand line, but that unit cost has clearly come down by more than price has done. And if you're looking to get top marks, then that's the sort of analysis that you're going to do. If you do it in a very technical sort of a way. That although price comes down, demand's elastic, but that overall, because cost per unit goes down by more than price per unit, and we're selling more units, our profitability has risen from the black shaded area to the blue one. Or what you might have done is you might have kind of talked about the real world. That an increase in scale allows the firm more marketing power. It's got bigger market share. It can it'll have more loyal consumers and so on. And that's another way of getting to kind of top level analysis. The combination of this this diagram combined with economies of scale and a clear explanation of why profits might have increased. That's pushing you towards AA Starland. The obvious counter-argument is then say, well, it's not necessarily the case, of course, that an increase in scale will reduce unit costs. We might get diseconomies of scale because of problems with coordination and that type of stuff. As a result of that, what's going to happen is, of course, unit costs are going to go up, and the firm's profits may well go down. So if we imagine, that gives us a significant increase in scale. The minimum efficient scale is clearly much greater. Its minimum point is there, so marginal cost goes through that. So the scale of the organisation has increased. But overall, its average costs are being driven up. So we then say, well, what's happened? We can see that the profit maximising output here is Q2. Again, like last time, because the firm's selling more units, its price has come down. But because of diseconomies of scale, the firm's costs are a lot higher than it was before. So whereas previously it was making a profit of P1 C2 times Q1, now it's got costs at C2, price at P2. Costs are above price. So it's making a loss of that area overall. I mean, there are different economies of scale and diseconomies of scale diagram that you can use, but I think the key point is that you do try and show what's happening to overall profitability. The other way you can go on this, is you can be a bit less technical and talk about what's happening in the real world. So we can talk about the scale of Amazon that's increased. I mean, enormously, or Google over the last 30 years, 20 to 30 years, and it's clear that they've been able to use their scale to short term make lower profits, because at the point at which you expand, profitability is going to be driven down because you're not using it. But then they've been able to leverage that and make more profits in the long term. So that type of short term, long term, kind of the initial point of expansion, increasing scale is going to reduce your profits, whereas in the longer term it may well increase them. That's a perfectly valid approach. And just to think about you might go down kind of the idea of state-run businesses, that as they increase their scale, the possibilities for inefficiencies, discount on scale become greater. But the main is, the best answer is going to be one that has a strong technical understanding and that's also rooted in the real world. So that would be my recommendations too.